share my screen. Yep. All right. So actually, this is a point from the last week's discussion, which I couldn't actually cover, but I'll actually take this point for maybe I'll do a separate video on this one, just for the DeFi channel to just review. All right. So things that we will probably cover today. So the first thing I really want to just quickly recap on is on what you actually need to use a DeFi protocol. So the tools and how it actually works. And then I'll be looking at the types of DeFi protocols that are there. So just a basic overview of the different types of DeFi protocols. I'll be focusing on lending and borrowing, because that's the gist of DeFi is based around lending and borrowing and decentralized exchanges. And I'll be actually touching derivatives and margin trading. I won't be touching much. I'll just giving a basic overview, but I think that's a separate topic altogether, and I'll just see the vibes of the community. What they want to really focus on, and insurance is something that is not talked about enough, and not many people know much about it. So I thought maybe I'll talk a bit of DeFi insurance and really the powerful impact it could create to get more retail and even institutional investors on board. So in terms of what you need to use a DeFi protocol, well, the beauty of using a DeFi protocol is all you need is an internet connection and a compatible wallet. So there's no pre-registrations and no signups required, unlike on a website. So to answer the question of what wallet is required really depends on what blockchain the protocol is built around. If the protocol is built on Icon, for example, you can use IconX, MyIcon Wallet, HANA, which is obviously an extension of HANA, of my Icon Wallet as well. If it's built on Ethereum or Binance Smart Chain, you can use MetaMask. There are also wallets that are compatible with multiple ecosystems, like a hardware wallet, like a Ledger or Trezor. So it really depends on what protocol and what they allow you to interact with. Now, why do you need to use a wallet? Well, a wallet is basically needed because there needs to be a tool for the blockchain to interact with, in a language that it really understands. In other words, or in simple technical terms, wallets create a transaction object to the blockchain, instructing it to lets you know exactly what it wants. So this transaction object has information like the sender's address, number of transactions, or the nonce the wallet is interacted with, amount of coins to be transferred, the maximum transaction limit, and also a very unique and important security information, which the private key has to sign off the transactions, so that the blockchain knows it's a genuine transaction. So that's built on the encryption of and the security of the wallet and the network. So if you really want to get an in-depth understanding of how wallets interact with, I'll put the link to the Udemy course on smart contracts and Solidity and all that, which is really good if you really want to get an in-depth understanding of that. Right. I hope that part was clear. So I just wanted to now just quickly move on to the different types of lending protocols. So lending and borrowing is something that I really want to focus on. So now, actually, when it comes to lending and borrowing, in the traditional finance world, obviously we have a bank. It uses customer deposits to make their money. by lending. So it uses the customer deposits to make the money by two ways: lending out to in terms of loans, and then investing in terms of investment markets. So the bank pays out interest, as a token for depositing their funds with them, and receives interest for money it lends out. So the investment spread is where they make their money. So different bank products obviously have different interest rates attached to them, varying from bank to bank. Also depends on obviously the creditworthiness of the customer. So the interest rates obviously vary from country to country, things like that. But the origin of the interest rates obviously stems from the LIBOR rates. So they keep the percentage on top of the LIBOR rates. I mean, the standard rates change, but fundamentally it's the LIBOR rates that they use, the interbank borrowing rates. So how does that differ in terms of a kind of concept of lending and borrowing in a DeFi space? So while the banks create the borrowing and lending ecosystem through traditional money markets, in the DeFi world, there are protocols or products that have the same function as a money market. So in the crypto space, there are DeFi money market products like Compound, Aave, Maker, in an Ethereum network, Ohm on the Icon network, which is going to be launched very soon, and CeFi products, centralized finance products like BlockFi, Celsius. So in a typical money market protocol, we pretty much have two user profiles. You have the supplier and the borrower. So the suppliers pretty much deposit crypto assets to a particular money market protocol. When you deposit into money market protocol, obviously, like I said in the first session, you deposit into a smart contract. So that smart contract will give out tokens to the supplier, which will equal the value of the assets provided plus some interest. So these tokens, could be O tokens in Ohm, C tokens in Comp, A tokens in Aave. So deposited assets, are made available for borrowers to utilize up to the permitted value of a respective borrower's collateral. So this is, in other words, known as over collateralized loans, which in effect just means that you have to have your assets have to be worth more than the loan you're taking for. You're taking a loan for. So how much you can borrow depends really on the collateralization factor of the asset. So you plan to borrow and how much supply there is in that protocol for that asset. So one of the aspects of things I want. So these are what I mentioned right here is I want to just kind of get you in just a basic overview of what kind of aspects that you need to know when using a money market protocol. So how long do you have to pay back the loan? Unlike traditional finance or traditional borrowing and lending markets, there is no actual no timeline as long as you satisfy the condition of you don't get liquidated. So as long as your deposit amount, your borrowed amount, doesn't exceed the liquidation threshold, you're fine. So that liquidation threshold obviously varies from possibly even to the extent of asset to asset, from protocol to protocol. So obviously you can go to the FAQs of each protocol and or even the white paper if it's not launched yet, and just see all the thresholds and the collateral factors that they all intend to have for each asset that you provide liquidity for and you take a loan out for. So yeah, and what happens in terms of liquidation? At liquidation, it means your borrowed amount has gone higher than the liquidation threshold, which will, as I said, vary from asset to asset. So when you're faced with liquidations, your loan needs to be brought back to the new maximum loan to value ratio. So the difference of bringing the existing loan amount to the new loan amount will be the amount your collateral will come down by. So And also there will be usually a liquidation penalty which should be charged. You know, should be charged. So obviously that discount and the penalties and everything will be depend on protocol to protocol. Uh, it's kind of it may not be easy to understand without an example. So I really want to take the opportunity, maybe afterwards or in the weeks leading up to the launch of Ohm, uh, just we can run through some examples on the DeFi at the text channel. So if you guys really want to get an understanding of that, but I'm sure if you've been using Balance, you kind of have somewhat of understanding that there are differences, obviously, between taking out a loan in Balanced and taking out a loan in Ohm. But we'll be happy to help you on that. The other thing is how are interest rates calculated. So I just want to take you through. I just want to take a few, just compare a few different protocols, just to take you through that aspect of it. So yeah, so here are like two Ethereum based protocols. There's Compound and there's Aave. And obviously Ohm, which is obviously not launched yet, so I'm just taking it out from the white paper of Ohm. So essentially, like I told you, there's obviously two users in the protocol. There's a supplier and there's a borrower. So the supplier rates or the interest rates that you earn from providing liquidity is basically paid off by the borrowers. So the supplier rates in Ethereum, in Compound and Aave, and also Ohm, is the same model in terms of it's paid off by the borrower. The rates obviously vary, and the calculations that they use vary. For example, Comp has 16 interest rates models that they use. The last I checked, so it really depends. What they actually or they use. So yeah, in terms of supplier rates, yeah, so they all vary according to the utilization rates. So it really all depends on the demand of and the utilization rate of those assets. So the only difference is I didn't really want to bring it up is Anchor, and Aave also does have fixed products as well, but Anchor I didn't really want to bring it up this point because it's a bit complicating for an introductory session on that. So they have fixed supply rates. I mean, it's not that it's fixed, but it basically fluctuates between a certain range, which is decided by the committee members and the governance members, which they obviously vote on. So it's slightly different to the other protocols that I just mentioned here. In terms of token distribution model, this is actually pretty important because Aave and Compound, so Compound gives C tokens, Aave gives A tokens. So when so it basically depends on the block model. So they hand out rewards based on each block, which changes with time. So with Aave, it's a 1-to-1 ratio. Ohm will also follow the same model. So each time that there's a block gets pretty much processed, so to speak, you receive more A tokens in return. Whilst in Compound, the initial value of the loan that you've given, the tokens that you've given, remains the same. It's just the value in relation to the asset that you've borrowed against or provide liquidity for changes in value. So I've just given an example here, so I hope you kind of understand that. In terms of product offerings, it's compound. It's basically variable APRs. Home finance obviously is also again a variable APR product. Aave, as I said, provides fixed APY loans and flash loans as well. Right. Yeah. Is it clear so far, Daiki? Is everything?
No, everything's clear. Yep.
Yep. So in terms of decentralization, DEXs is the other subject I want to talk about. So before understanding what's really going on in a DEX, let me just take you through a TradeFi equivalent of a DEX. So in a stock exchange or a centralized exchange like Binance and Coinbase, the buying and selling of shares, takes place through an order book approach. So pretty much buyers and sellers publish a rate at which to buy and sell. Logically, buyers would look to buy, at always cheaper prices, while sellers would like to sell at higher price. So kind of to execute trade, buyers and sellers really need to compromise to execute trade. And practically, this would take time, or it's not be practical to do so. So this is where pretty much market makers come in, and market makers are pretty much institutions that buy and sell assets at any price at any quantity. So this order book model is not an approach what a DEX takes. So although there are like layer 2 solutions like Rootring, which does use an order book model, and the reason, the pretty much the reason why an order book model is not popular is because of a couple of things. It boils down to how a blockchain and smart contracts work. It's similar to the concept what I told you about why websites and social media apps aren't that actively used on blockchains. So the way the market maker works, makers operate, they constantly change the prices. Hence, there are multiple orders and order cancellations that come through. So if you were to do this on a blockchain and smart contract environment, there would be a lot of gas fee and transaction fees that would be used, and it would be slow, costly to implement as well. So even in layer 2 solutions, like I mentioned, they're dependent on market makers. So so even if you want to withdraw or deposit, it's a multi-step process. It's not as user friendly as what it could be. So that's where DEXs come in, and so how does things work on a decentralized exchange? So it pretty much uses the concept of liquidity pools and automated market makers. So pretty much an automated market maker is pretty much like a type of decentralized exchange. So that relies pretty much on algorithm based. So it basically works similar to order book exchange, but there's always constant flow of a pool of funds, which obviously that traders can trade with. So if you could think of liquidity pool, as I mentioned, as a big pile of funds that traders can trade against. So in return, when you provide liquidity to the protocol, the liquidity provider earns fees from the trades that happen in the pool. In the case of Uniswap, liquidity provider deposit an equivalent of 50% ETH. For example, if it's ETH DAI pool, so they use a concept called constant product market makers, which is a 50-50 pool. So that's as what I mentioned. That's one type of product that they use, a constant product market maker. and Curve Finance, use a different algorithm, and their main pools, mainly for stablecoins, liquidity. So they realize that constant product market maker is not the best, for certain situations, like where there's stable coins, or where there's variations of that particular asset, like ETH or WETH and things like that. So so the third model is a balancer users, which is more, they use more than two assets in a liquidity pool, which obviously reduces the chances of the impermanent loss. So what is an impermanent loss? So and the impermanent loss, pretty much happens, when the price ratio of the deposit tokens, basically change. Or it's pretty much like if you think of it this way, it's basically the difference between if you had held the two assets as opposed to depositing into a liquidity pool over time. When the prices do change, what the difference of the loss is. Most of the time, it's pretty much guaranteed that you will lose in terms of the actual value of the tokens that you put in against hodling. But that is usually offset by usually the DEX usually pays to the liquidity provider network fees, and usually the native tokens are also given as remuneration. So if you're long term believer in the project of that DEX, and you believe in the governance tokens, then that's the way to go about it. If you are not too comfortable with impermanent losses, and again, let me mention, impermanent loss is a loss that is not realized until you take the money out. So that's why it's impermanent. So if you're not too comfortable with impermanent loss, or taking a loss on your coins, and you don't really believe too much on the governance tokens of a protocol, then I suggest you look at a stablecoin pools, or pools like variations of one coin. So on balance, you get ICX and SICX and things like that. So it's really important that you kind of understand what impermanent loss is, and how to understand the losses that you could incur if certain worst case scenarios are met. Obviously, the other type of risk, obviously, you get in a DEX is obviously smart contract risk, admin keys. Obviously, that's another risk that is likely. But if you do deposit to a protocol that has been there and has high TVL, then you pretty much avoid those circumstances. Right. In terms of insurance, that's something that I just want to quickly just go through, because that's actually something that a lot of people aren't really exposed to, or don't really take insurance. So um, it's not the most exciting topic in crypto, and not many retail really takes part in actively investing in insurance protocols. But it pretty much, as in traditional insurance, it pretty much is there to it basically empowers individuals to take risks, by kind of covering them. So readily available insurance, coverage, gives a user confidence to deploy, capital in DeFi products. So the only problem is, DeFi isn't really mature, so there isn't really enough sample size or information for underwriters to pretty much do all the actuarial calculations and things that to come up with, to come to basically quantify their risk. So that's fundamentally the main reason I see in DeFi insurance is one side, the underwriters really don't really have enough incentive uh, to get yield, because yields aren't really that high in if you want to be an underwriter or invest in it, as opposed to yield farming. The other problem is if you are a buyer of insurance products or discretionary products, it's really pretty limiting in terms of the coverage, and also it's pretty expensive as well. So like that's fundamentally the main issues behind it. So principally, obviously, the risk, obviously, in terms of DeFi, comes from obviously, smart contract risk. And also the other problem is DeFi is constantly evolving. There's always new permutations. So essentially, it mainly covers is the smart contract risk, obviously yield. It does cover for kind of rug pulls and things like that as well, which I'll just cover a bit shortly. So yeah, so as I mentioned, it's a very primitive, it's a very new and nascent industry. So there are quite a few issues in DeFi insurance. So the obviously the two biggest players in the space is Nexus Mutual and Insurace. Nexus Mutual model is they're built on Ethereum. They offer decentralized discretionary products. Why I mentioned discretionary is because and not insurance is because it's a mutual, and hence there is really no obligation to pay out. So it's really important to be aware of this. So Nexus Mutual is structured as a DAO, and it's wholly owned by its members. So the members are the risk assessors, the claim assessors, and are incentivized via staking rewards for providing, for being a risk assessor and being a claim assessor. If you kind of understand what I'm saying. So you're pretty much incentivized to do the right thing. So in case you don't lose, in case a claim assessor acts doesn't act according to the claim, or basically doesn't do the right thing in terms of honoring the claim, there are voters behind which obviously vote for each decision made on the claim. So the claim assessor pretty much has a chance that he'll lose all these coins. So it's really incentivized really well. So the main things that Nexus Mutual obviously covers against is yield token cover. There's protocol cover and custody cover for CeFi products. So they pretty much just cover the whole gamut, not whole gamut, but they cover for protection against if it's custody cover, they protects against withdrawals or basically haircuts on your funds stored on your exchange. Then there's obviously protocol cover for protects against hacks. Yield token cover if obviously that the value of token is subject to a hack, so they refund you up to the amount of the price before the hack occurred. So as I said, the challenges of challenges of a protocol is who acts as an underwriter and how is the risk price. So no matter the model, someone has to underwrite the policies. So as I told you, nobody really has the confidence to kind of to understand the risks of each product. So right now, I think even especially Nexus Mutual, what they kind of do is they so so they so the obviously the value of the product that insure against really depends on how many people staking are actually providing capital for that product. So if obviously uh, the obviously risk obviously lowers based on how long a protocol has stood the test of time, or how high it has TVL locked in. So those protocols like Aave and the comps and all who have been and tried and tested, are usually are the ones that they really put out for insurance. Obviously, the other point I mentioned is the underwriter yield must compete with DeFi yield. So really, there's not much incentive when you really look at it, when you compare the relative returns of being underwriter. Um, yeah. So yeah, that's pretty much what I wanted to just cover in terms of that. Um, yeah. So as I said, um, margin trading and derivatives. I'll be happy to kind of go on it on a separate section, or really depends on what the users really want to know about it. But yeah, Daiki, if maybe before I go into like stable coins, is there any other questions or anything that we can discuss before that? The last topic.
No, I think we can move on to stablecoin. I think you covered kind of the main pillars already: the insurance, the lending, borrowing, and then the DEX part. I mean, I guess since you just covered insurance, insurance is definitely like a sort of a protocol that is missing on Icon. It'd be good to kind of see, I
Yeah.
guess, come up in the Icon ecosystem as well.
Yeah, I think that's really important, and I think they really haven't really got that part of that right, because obviously insurance is, yeah, I mean it's very difficult for a smart contract to put all the logic in to kind of assess claims and things like that. So I guess it's very difficult to decentralize that 100% or things like that. Or
Yeah, I mean, the part with insurance, though, I mean, it sounds like you may have done more research, so you may know more than I do. But as you mentioned, there are some, like, I think, bottlenecks
yeah,
for making it really usable right now. I don't think there's really any properly working insurance protocol. I mean, there are some out there, as you mentioned, like Nexus Mutual and whatnot. But I mean, if you look at the coverage amount, it is still pretty low. And then, I mean, I still have like a doubt, like in case like a black swan event happens and like some massive, uh, one of the main DeFi protocols gets like I don't know, exploited, and then like that has like basically cascading effects on other
yeah,
protocols that are built on top of that, and then like that's something like even like Nexus Mutual may not be able to cover. So there is a lot of like what ifs, I think, in the insurance protocol space just yet. So I will be curious to see how this unfolds in general.
yeah, and I think it's really like you hit the nail on the head in terms of the bottlenecks. Yeah, it's yeah, it's a big issue, but hopefully these things are really needed for DeFi to really grow. Yeah, so
Yeah,
coming back. Yep, sorry.
I think in the end, like if we can have an insurance, like I think that would be like a kind of when we'll see like a real mass adoption happen. Like people are kind of comfortable with insurance policies in general, right? So if we can put, for example, provide like stable coin yield with insurance on top of it, I feel like that's something regular folks would be more open to in general.
Yeah, I mean I don't use Terra. I'm not use Terra in terms of DeFi or Anchor protocol, but they have some insurance products on that. So it'll be really interesting to know the if someone had some statistics on how much is insurance products are really bought on these new uh, blockchains like Terra. Yeah. So On just the last topic I really want to discuss is on stablecoins, because you need to really have an understanding of stablecoins and the different types. So I did mention the types in the last session. So you get the two main, obviously, the algorithmic and non-algorithmic. Non-algorithmic is broken down to fiat collateralized and crypto collateralized. So in terms of fiat collateralized, that's the most popular. It's pretty much backed by fiat currencies. So it's a basically a one-to-one backing. So it's pretty much these centralized rely on a single actor to issue IOUs, which are obviously redeemable and convertible. So uh, obviously the most famous is things like USDT and USDC, which are fiat collateral examples of fiat collateralized um, stable coins. Immediately, the advantages of is it's less volatile. It's obviously easy to understand because it's the same concept. From a banking perspective, it's really nothing. Or from a traditional finance perspective, it's really not a thought provoking concept to understand. It's less vulnerable to hacks, and it's obviously scalable. In terms of disadvantages, obviously, you've heard every few months you hear uh, uh, issues on the collateral. Is USDT sufficiently collateralized? I don't know if it's FUD or not, but every few weeks or few months you get some scare about how USDT is going to be the downfall of crypto. Uh, yeah, so that obviously comes from the centralized operations and the lack of transparency. And obviously, as I told you, it's not a new innovation. Fiat collateralized is something that has been there and has been there. In terms of the other perspective is crypto collateralized stablecoins. So they're pretty much backed by crypto assets. So these decentralized stablecoins rely on trustless issuance, also referred to as on-chain issuance, and kind of they maintain their one-to-one peg against assets via over collateralization incentives and other methods that's available. So the immediate pros is it's decentralized. It's obviously on chain. Um, uh, yeah, and obviously there's no counterparty risk, and it is also actually scalable as well on that on that point. Um yeah, so in terms of disadvantages, yeah, obviously, it's not very capital efficient because obviously, as I told in the last session, you have to protect yourself against volatility. So you want end up, protocols. Obviously, stable coin issuer, has to pretty much protect themselves against the volatility. So it has to over collateralize itself to protect itself from fluctuations of the price um, of the crypto assets it's collateralized against. Um, yeah, it obviously can be subject to liquidated or liquidations through price crashes. Um, Obviously, it's less price stable than fiat, obviously. In terms of the other aspect, if is non-algorithmic, algorithmic stable coins. So it's pretty much, so there's no understanding, or there's no collateralization that comes up, but as the name suggests, it's all mathematically configured. So through the supply contraction and expansion of the supply, so that's how they manage to maintain the peg and to maintain the stability of that stable coin. So yeah, so in terms of advantages, obviously there's no collateral required. It's transparent, inauditable. It brings the same benefits of crypto collateralized stablecoins. So obviously, I forgot to mention an example of a crypto collateral stablecoin is obviously DAI, BNUSD. If you want to talk about it in balance. In terms of disadvantages, obviously, how much downward pressure can the system take. So obviously, how much selling can obviously it costs to maintain the peg. So it's really unknown. How much it can take. Obviously it requires continuous growth. And obviously, there's vulnerability in the peg. I'm not exactly on the technical aspects on that front, but I'm sure on the DeFi Academy channel, if you have any questions on that aspect, we can really help you on that as well on that. But yeah, that's pretty much what I want to cover on that. Yep. Yeah. So I mean, I just really want to get. I mean, want to get people's feedback in terms of or maybe I can ask you, Daiki, in terms of what really would you like to see next on Icon. I mean, you mentioned insurance. Is there any particular protocol that you kind of liked outside of Icon that you like to see kind of soonish?
I mean, I think you covered a lot of the basic Lego pieces. So in terms of like what's hot in the I think DeFi space right now, I think the leverage and perpetuals I think are getting quite a bit of interest because I think because of the regulation crackdowns, a lot of the central exchanges are lowering their leverage amount. I think Binance did that and then FTX did that as well. So
Yep.
protocols like perpetuals and whatnot, DYDX, I think they just mentioned they're going to do airdrop. These guys, I think, are getting a lot of attention because those who are doing more leverage at central exchange are now kind of forced to rely on the decentralized version. So that's getting some interest. Insurance I already talked about. I think algorithmic stablecoin I've also found it pretty interesting. Started everywhere from how Terra is doing it.
Yeah.
All the way to like ESD, DSD, and then now the latest one, the algorithmic stablecoin, is called Ohm, and I think Faye is another one. There is some positromics there, and then there's some innovation there. So it is quite of a intricate topic, but I think whoever figures it out really well, I think it can be really interesting as well. So if anyone's interested in working on I'd love to kind of see that happen as well.
Yeah, I think you hit the nail on the head in terms of perpetuals. I mean, I actually tried on DYDX yesterday because I do use DYDX. I've lost. I think a few months ago, the last time I traded on DYDX, and the gas fees was insane. It was ridiculous. And then the layer 2 solution. So obviously the airdrop what they kind of provide now is you can only claim the airdrop if you actually use the layer 2 product on DYDX. And I've actually not used it, but one of my friends used it, and it's a big difference in terms of layer 1 to layer 2. It's interesting to see how that goes as well. Yeah, I mean, anyone else who kind of, I think I've spoken to Steven quite a bit on the Om channel quite a bit. He's very active. And any thoughts, Steven? Not really.
Or even TJ, to that matter. Sorry to put you on the spot, but anything you're interested in these days, TJ?
Yeah, sorry guys, to put you on the spot, but yeah, just
You're unmuted, but we can't hear you for some reasons.
Yeah.
Maybe voice chat isn't working well for some reasons. Yeah, well, another thing I'm looking into these days is also like a play to earn model. I think with the explosion of XCs and like Nebula launch of Nebula, I think the future will eventually be like a combination of like, these metaverse, NFT, DeFi, and DAO.
Yeah.
I think all of them will eventually come together. So, I mean,
Yeah.
that's kind of the ultimate area that I'll be interested in, like seeing everything come together in the end.
Yeah, it is really like NFTs, and as you mentioned, I love it, and it's really interesting. Even DAOs right now, the treasury, the fund, they're really, they even part of the treasury, they're kind of investing in NFTs, and it's really crazy. I mean, in terms of the blow off, or the real use case for NFTs, it's really immense.
Yep. Hopefully, we'll see some of that on Ohm as well. I think we're trying to have some Ohm NFT as well, and then, yep, hopefully that can be a good mechanism for coordination within the Ohm community as well.
Yeah, and I think hopefully we really want to get everyone on this channel. Whatever you guys, whatever thoughts that you want to discuss, whatever areas that you want to go through, we are happy to discuss it. From next week onwards, as I mentioned at the start, it's going to be a lot of interviews. It's going to be interview based. We're going to talk about yield farming strategies. We're going to talk about governance. Probably get Scott and also Daiki to pick their brains on about certain risks involved in DeFi protocols, and see what kind of things that they're doing from a protocol perspective to limit those risks. So, and I'm really excited for the next weeks ahead, and also looking forward to Ohm launching.
Yep, same here. And then maybe we can, I think, try a different time next week.
Yeah.
To see if that, how it works for other people as well. Maybe like, morning time of your time zone, ours.
Yeah, so I'll quickly I'll probably do a vote and just see how that goes, and just get their feedback as well.
Nope, sounds good.
Hey guys, what's up? Was curious, is this recorded anywhere? I joined the meeting late. I just wanted to know if there was anywhere I can like listen to the beginning. I couldn't ask any questions.
Yeah.
I'm sorry about that.
Yeah, it's recorded. Actually, I just missed a couple of minutes of the first bit because I forgot to start the recording. But apart from that, you can just the first minute or two you missed out. But yeah, it's pretty much recorded. Yeah.
All right, I think we're good. Pretty excited for the next one as well. We have a lot of guests coming in to kind of talk about different yield farming or liquidity mining strategies once Ohm launches with Bounce as well. And then now we have Craft also doing, you can also do liquidity mining and Craft as well. So a lot of things to do on Icon these days. And it'd be fun to kind of talk about these things.
Yeah, and obviously price movements, get the crowd growing as well. I think, yeah.
All right, should I call it?
Yeah. All right. Yeah. All right. Thanks, guys, for your time as well, and take care.
All right. Thanks, guys.
Take care. Bye.